Time for Past Picks. We go back to May 17th of 2017. You liked CCL Industries. Been a choppy ride since then, but we do have a total return of almost 8%.
Yeah, this is a great company. I've said it lots of times. It's well managed. They've been able to grow over time. It has not been always the most liquid stock to be able to trade, so it's maybe better for smaller investors. But they've done a very, very good job of growing the business over time. It's a strong company.
It's one of those companies, too, where we don't think of packaging products as sexy, but if we start thinking about online commerce and things needing to be delivered to the door, there's still a very traditional business in between me ordering something online and it showing up on my front door.
Absolutely, and they do benefit from that.
This is an interesting name that people are trying to wrap their head around. A lot of the themes were there for a long time, Cineplex, but last summer, that's when the pain started to show up and all the concerns about us changing the way that we consume entertainment.
That's right. So this is a company we owned for a long time. Coming into the second quarter earnings last year, some of the earnings revisions started to weaken. And then when they finally released their quarter in the second quarter, it was clear that there was a change in behavior and visits were down. Now, I love to use an opportunity like now to talk about how important it is to have a plan as to how you're going to exit something if it doesn't work. You know, we use stop losses on every one of our positions. We don't enter a position before identifying an exit point before we enter, and the difference is our risk budget. If a position works out as we hope or expect, we steadily ratchet the stop
loss, trailing it up higher. Yeah.
And if we break the stop, we break the stop. And this one we got stopped out of last spring, not that long after we put it up. But that's what happens, and that's why we have a portfolio. You're going to have some really good ones and some ones that don't work. And as long as the ones that don't work don't hurt you too badly, that's the way you make money.
I know people now look at the yield of 5.5% and wonder, can they turn it around? Have you been looking at the name, or you got stopped out and you just moved?
No, we don't ever try to buy a turnaround. My big belief is you buy things that are good getting better, especially if you're in a decent market. You want to buy the things that are participating right now. There are people who make their living saying, the market's wrong, I'm right. I think it sets yourself up for making big mistakes. So technically speaking, the stock's broken. The earnings picture has been weak. I can't see how you could buy it in this market.
All right, here's a name that's trading at less than 10 times earnings, but you got a total return of more than 28% out of it, Magna International.
This is just a great company. And, you know, I would continue to buy the stock right here. It's a company that grows in excess of its industry average. It's a company that is cheaper than almost every major company in the auto parts group. They are, you know, in a growth area of the market. They can participate in a lot of the big themes like heading into autonomous driving, sub-assemblies, and it's a company that benefits as Europe improves. So this is, I think, the leader certainly in Canada in auto parts, and it stacks up against almost any of the U.S. auto parts and assemblers. So I think it's a great stock. I'd be a buyer here.
And a 2.26% yield on top of all that. We'll be back after this short break. Our number, 1-855-326-6266. We're talking North American large cap, so send us your questions.